Hey guys, Rafi here from the Endgame Investor on Seeking Alpha. You can find me under the pen name Australib on seekingalpha.com. So today I'm going to try to explain why last night's gold dump may have been the last one until the endgame. I'm not calling it definitely, but there are signs and indications that that is what is happening, and I'm going to explain why right now. So there are two narratives in the gold versus monetary policy interplay. One of them is that the Fed is in control, and the minute it starts tapering, price inflation is going to be under control, and all the geniuses at the Fed have got everything under their arm, under their knuckles, whatever it's under. And you don't have to worry about inflation because it's all transitory and forget about it. So whenever the Fed starts tapering, there's going to be no more serious price inflation, consumer price inflation, and everything will be normal. So you don't have to buy gold and you can sell it off, and that's it. So anytime there's news of a taper or an expected taper, then gold sells off. So this is what happened on Friday, and it continued into Sunday night when the futures market opened and gold sold off all the way to its previous bottom of 1677. So if we look at this article first, you can see this was coming back on August 2nd, because on August 2nd, the Bloomberg article here is Fed's Waller says September taper call may be warranted. Okay, so what happened here? It says here that Federal Reserve Governor Christopher Waller, and this is a no-name guy that they put out for media trial balloons to see what the market's going to react. Christopher Waller said that if the next two monthly U.S. employment reports show continued gains, he could back an announcement soon on scaling back the central bank's bond purchases. I think you could be ready to do an announcement by September, Waller said Monday in an interview on CNBC. We had a supposedly good jobs report of 900 whatever thousand, and it surprised the market to the upside. So then this sort of narrative kicked in. Everybody expects the Fed to taper now, and that's why gold was selling off, and there you have it. Now, the question is, when is this going to end? When that's what everybody wants to know. And I'm not going to give you a specific date because I don't have a specific date, but I can show you the conditions that need to be satisfied in order for the narrative to change. From what to what? From the Fed has everything under control. Once they start tapering, price inflation will be under control. Don't worry about it. To the Fed does not have anything under control, and they will start being led by price inflation instead of traders trying to front run the FOMC announcement or the taper and trying to front run that and smashing gold in advance of that. So when does that change? So I can show you the last time that it changed, and it did change. That you can see on this chart here. I have here on Fred the effective federal funds rate in blue. This is from the 1970s versus the gold price in red, the London fix. So here, if you remember the 1970s, we went off the gold standard, quote unquote gold standard in 1971. Nixon closed the gold window. I don't like that terminology, but I use it because people recognize it. Went off the gold standard in 1971, and gold started rising into 1974, into 1975, and then it started falling again with the blue line, which is the effective federal funds rate. So the Fed was loosening monetary policy, and gold was falling for about 2 years, 1975 to mid 1976 or so. And the effective federal funds rates kept trending down until we see here, until around, or exactly, January 1977. So January 1977, gold was at $131, and the effective federal funds rate was at like something like 4.3. And that is the cycle low for the effective federal funds rate, the overnight rate that the Fed controls almost directly. And then something changed. Totally changed. You see here, the Fed starts embarking on the tightest monetary policy in all of its history. The blue line, the effective federal funds rate, the interest rate hikes that we're told to expect by the mainstream media, or that what they call the overnight rate, starts to rise fast. Goes from about 4.3% all the way to, this looks like just under 18%. I don't know what the exact number is. And all that time, gold kept rising. So something changed. instead of gold being led by monetary policy was being led by the gold price, or more accurately, price inflation. So why did this pivot happen? Here, actually, the next chart. Here we see the consumer price inflation index from the 1970s, from the same time. So we see here, this is when gold kind of peaked out and started falling with the price inflation rate. Right here, where my arrow is kind of circling around, that is January 1977. That time, the consumer price inflation rate started to rise again, and it rose strongly for the next 4 or 5 months. And then it hit a lull for another few months, maybe about a year, and then it started rocketing off. So January 1977 was when this pivot happened, when gold was no longer responding to monetary policy, but was leading it. So when does that pivot happen in our era? So there's 3 factors here. Basically, we have to start seeing price inflation get a little bit out of control. Meaning once the Fed starts to taper and reduce its bond purchases from 120 to, God forbid, 100 billion or even 80 billion, inconceivable that they should only print $80 billion a month. Once they start doing it and the price inflation indexes don't fall as the market expects them to, then price inflation will be in the driver's seat, and will start dragging other prices higher. And then you start a psychological feedback loop where the higher inflation is, the higher people are willing to pay, higher prices people are willing to pay, in a positive feedback loop. And that's where hyperinflation comes from. It's a psychological change. So we have here a CNBC article. It says container shipping rates from China to the United States have scaled fresh highs above $20,000 per 40-foot box, as rising retailer orders ahead of the peak U.S. shopping season add strain to global supply chains. So here's the scary part. Now, it says here rate hikes. Not rate hikes, interest rate hikes, but shipping rate hikes. The spot price per container on the China-U.S. East Coast route, one of the world's busiest container lanes, has climbed over 500% from a year ago to $20,804 this week. Now, here's the scary part. That compares to just under $11,000 on July 27th. Today is August 9th. So this article is from, what's the date? It's from August 5th. So from July 27th to August 5th, shipping prices have doubled. So that's going to affect all prices of imports, and the prices of everything are going to go up. Here's an old chart from back in June from Supply Chain Advisors, Drury Supply Chain Advisors. See here that shipping started going off the rails around here on December 2020, then declined for a little bit. And now both lines, the Shanghai Los Angeles line and the Shanghai Rotterdam line, are pretty much going vertical. And this is when, the peak, the Shanghai Los Angeles, was below 10,000. Now it is over 20,000. So the line would be off the chart here. This chart is obsolete now. Now we go to FT. Yep, you read that right, says FT. Prices jumped by almost a third over the course of a single month. So what does that mean for price developments? Is it transitory or not? The result is that it's hard to see costs falling back to pre-pandemic levels until Chinese New Year 2022 at the earliest, the next period when you'd expect cyclical demand to ebb, and more likely not for years beyond that. So FT says for years, shipping prices are going to be elevated. And that is going to gradually bring the prices of everything that's imported into the United States much higher. Now, second factor we have here, what has been pushing the price inflation index? Reuters, I think, put out an article. Analysts are expecting price inflation rate by the CPI to start ebbing down because, car prices are going to start plateauing. Maybe they will. But here you have domestic auto inventories. Okay, this is a chart from Fred, all the way going back to 1993. That's as far as it goes. And you see here that domestic car inventories are at an all-time low. When inventories are at an all-time low like this, and you have supply problems and shipping, then what happens is that retailers, car dealers, have to conserve their inventories, so they can't lower prices. The blue line at the end of the chart here, the blue line is used car prices. What has been pushing the CPI up lately has been mostly used car prices. Now, why, even if used car prices start to plateau, why won't the factor pushing the CPI up from used car prices go down? Because year over year, car prices started rising vertically around April, which means the year over year statistics won't start to ebb until April of 2022 at the earliest, because that's when they really started to rocket higher. So even if used car prices plateau, those statistics are going to be stuck, embedded into the year over year CPI figures for about another 8 months. The next thing I want to talk about is rent. 24% weight of the CPI is rent. I think it's for used cars, I think it's about like less than 8%, 7.6%, something like that. Now, here is owner's equivalent rent, as the CPI right now is about 5.4% annual. And it's been affected by this vertical line of used car prices mostly. Now, owner's equivalent rent since January 2020, the rate of rent inflation has been falling from 3.34% to a bottom of about 2% in January. And now it's been edging back up to 2.1%, but it's about to get much, much higher. The reasons are, first of all, here's an article from August 3rd by Bloomberg. Title, Apartment Rents Post Record Gain as Tenants Flood U.S. Market. The biggest wave of tenants in U.S. history has arrived, and landlords are responding with the largest ever rent increases. Largest ever rent increases of the most weighted factor of the CPI. Now, there's something else going on in rents right now between the Supreme Court and the CDC. That's going to get cleared up because the Supreme Court has already declared it unconstitutional. This moratorium by the CDC. So the minute the Supreme Court asserts itself, hopefully soon, all of these squatting tenants are going to be evicted across the country, and rent is going to be pushed up in these areas. There's going to be no deals with these people because the landlords are going to want them out because they've already proven that they don't pay, and they're going to want to rent their properties to someone who will pay higher prices. So that's all going to flood in very quickly once this eviction stuff is all cleared out. Essentially what I'm saying is this. Over the next few months, you're going to have one of the highest components of the CPI, rent, starting to really rise. And car prices are not going to significantly fall in the year-over-year stats for about 8 months, at least. Shipping prices are going to be elevated for years, says Financial Times, and they could just keep going up. I mean, nobody knows. This is uncharted territory. Meanwhile, the Fed is talking about its taper, and eventually the market is going to expect that it can start taper. I expect that the Fed can taper a little bit, but it can't raise rates. That's a whole different story. It's not going to do that. But once the Fed starts tapering, and these price inflation statistics, which are psychologically important for triggering a change in narrative, once they don't start falling significantly on a taper, traders are going to start to suspect that the Fed is losing control. And somewhere in there, the narrative is going to change. Once it does, then there are going to be no more smashes because they'll be impossible. Meaning the traders are going to start looking at the price inflation statistics to tell them where to go, and not what they think the Fed is going to do. And when it finally does tighten a tiny little bit by buying slightly less billions of dollars of bonds, they're not going to think anymore that this is going to affect the price inflation statistics. They're just not. So then we'll be in the mid to late 1970s scenario. We're just waiting for that pivot. And what I emphasize a lot in my Service the Endgame Investor is that this is an emotional game. It's a psychological war. When you're in a psychological war, you need to have the ability to buy the dips, and to have the ability to buy the dips, which gives you psychological, emotional stability. When you have the ability, you can get through these things, and you can make money buying the dips and selling the rallies. That's what we do. That's what we will continue to do until this narrative changes, because it will change. It will change. And in the meantime, you just have to be smart, you have to be nimble, you have to be quick, and you have to understand reality. And the reality is gold is going much higher, the dollar is going much lower, and there is nothing the Federal Reserve can do about it, period. If you like this video, please subscribe to the Endgame Investor and subscribe to this channel. You can get a 2-week free trial and see how I manage emotional turmoil like this and how I advise my subs. Thanks.